Hello everyone and welcome to the Unanswered Questions True Crime Podcast.
I have spent hours and hours investigating this.
He basically told her that people have been killed. Journalists, independent investigators, people like that disappeared. It frightened her to the bone.
There's more to the story than meets the eye.
There were rumors of torture and homicide and sexual abuse, all sorts of egregious, horrendous crimes.
He was polygraphed 3 times. Each of those 3 showed evasions.
His resumes were a skeleton of truth.
He was mad at the world, and particularly mad at the government.
The study that he commissioned described a fictional terrorist attack.
If people have died over this, it means you're getting close to the truth.
You don't have to be a conspiracy theorist to say, what the fuck?
Now we get into the scope, types and techniques of fraud. BCCI's financial empire was built on the fiction that it was heavily capitalized by oil-rich Arab leaders, when the reality was that most of them, and according to some credible information, all of them were acting as nominees, providing either their names to BCCI or their names plus their funds in the form of deposits to BCCI to get a guaranteed no-risk return rather than as actual investors at risk. As a result, BCCI never had a substantial capital base and was forced from the beginning to use deposits to meet operating expenses rather than to properly invest them in legitimate loans or other financing. Not having the actual capital base, BCCI simply pretended it was there and enlisted the reputations of its shareholders to assist it in so pretending in order to lure others to deposit their funds with BCCI. As BCCI officers have told the subcommittee, BCCI in effect had to create retained capital out of operating profits through juggling its books because of the lack of real capitalization. Because of the lack of real profits as well, the supposed profits had to in turn be manufactured through juggling the books pertaining to deposits. These deposits in turn could only receive a good return on investment through taking the funds from new deposits, requiring BCCI to grow at a frenzied pace in order to avoid collapse. As Manhattan prosecutor Robert Morgenthau described in his indictment against BCCI of July 29th of 1991, to whose first 6 counts BCCI's liquidators pled guilty as part of the December 1991 plea agreement. Quote, BCCI's scheme was premised on the fact that the banks rely on credit. The essence of the scheme was to convince depositors and other banking and financial institutions by means of false pretenses, representations and promises that the BCCI group was a safe financial repository and institutions for funds, and thereby defendants acted to persuade depositors in banking and other financial institutions to provide BCCI group banks with deposits and credit. End quote. The New York District Attorney found that among the major actions taken by BCCI to carry out its fraud were employing the ruling families of a number of Middle Eastern states as nominees for BCCI, who pretended to be at risk in BCCI but who were in fact guaranteed to be held harmless by BCCI for any actual losses, using bank secrecy havens including Luxembourg and the Cayman Islands to avoid regulation on a consolidated basis by any single regulator of BCCI, and thereby to permit BCCI to transfer assets and liabilities from bank to bank as needed to conceal BCCI's true economic status, paying bribes and kickbacks to agents of other banking and financial institutions, thereby avoiding the scrutiny of regulators. Now we get into the Sandstorm Report, an insider's account of BCCI's fraud created by BCCI's own auditors Pricewaterhouse and provided to the Bank of England, dated June 22nd of 1991. The Sandstorm Report was the final evidence that led to the shutdown of BCCI globally on July 5th of 1991. That draft report, based on a review of banking records from several countries and interviews carried out through the spring of 1991, found evidence of widespread fraud and manipulation at BCCI, reflecting the general scale and complexity of the deceptions which have undoubtedly taken place over many years. This information was developed when Pricewaterhouse investigated some $600 million of BCCI deposits not recorded in BCCI's books. Other major losses related to BCCI accounts and related entities, including ICIC and the Grand Caymans, sometimes known as BCCI's Bank Within a Bank, the Banque de Commerce et Placements, a BCCI subsidiary in Switzerland, the Kuwaiti Investment Finance Company, KIFCO, a secret BCCI subsidiary ostensibly owned by a BCCI nominee. The Sandstorm report has been provided to the subcommittee solely in a heavily censored form by the Federal Reserve at the insistence of the Bank of England, which forbid the Federal Reserve from providing a clean copy of the report to the Congress on the ostensible ground that to do so would violate British bank secrecy and confidentiality laws. However, even with the hundreds of items and almost every identifiable name in the report censored, it is clear that the Sandstorm report outlined criminality on a vast scale. Among the specific types of BCCI fraud described by Pricewaterhouse and Sandstorm were account manipulation of non-performing loans, fictitious profits and concealed losses, fictitious loans set up in connection with repurchases of shares, misappropriation of deposits, fictitious transaction and charges, unrecorded deposit liabilities, nominee arrangements to create false capitalization, unorthodox and apparently illegal repurchasing arrangements for shareholders, the parking of loans to avoid recognition of losses, shoddy lending, bad investments, off-book transactions, false confirmations of transactions, misrepresentations with respect to beneficial ownership of shares, fictitious customer loans, falsified audit confirmations, and the drafting of fraudulent agreements. The Sandstorm report prepared by Pricewaterhouse for the benefit of BCCI's final group of managers brought in for the purpose of finding a way to help BCCI survive as a wholly owned subsidiary of Abu Dhabi describes BCCI's fraud rather kindly as originating in BCCI's sense of vulnerability in case of any losses because of its lack of any lender of last resort and the hostile attitude of the international banking community. According to Pricewaterhouse, to compensate for this weakness, BCCI's management, including Abedi and Naqvi, believed that it was essential to declare profitability every year regardless of the true financial condition of BCCI. Accordingly, Abedi and Naqvi provided guaranteed rates of return to principal Middle Eastern shareholders of BCCI and then falsified and manipulated accounts and records as necessary in order to pay those returns while still showing profits. When BCCI actually lost money due to poor lending practices rather than accept provisions for the losses, it simply disguised them through what Pricewaterhouse described as a very complicated series of manipulations of loan and deposit accounts, treasury activities, and purchases of its own shares. Pricewaterhouse found significant account manipulation at BCCI beginning as early as 1976. These account manipulations were, according to BCCI officials interviewed by the subcommittee, carried out in order to make BCCI appear to be far more profitable institution than it really was, and thus provide a sufficient capital base to justify its levels of lending and provide security for its deposits. As BCCI losses grew, so did its manipulation of accounts and its frauds, as well as its use of affiliated and related entities such as ICIC in the Grand Caymans, the Banque de Commerce et Placement in Geneva, the National Bank of Oman, and the Kuwaiti Investment Finance Corporation, KIFCO. The bank had a history of poor lending, where it now appeared that a significant amount of account manipulation had gone on. This had included the utilization of funds routed through Fork ICIC, including funds managed by Fork Investments, ICIC Investments, the use of fictitious INIs drawn down in the name of third parties, and the use of unrecorded deposits in an attempt to avoid the need to make provisions. This routing of funds has been carried out on a very significant scale, involving a number of related companies, including the Fork Holdings Group, ICIC Holdings Group, Loans, MBO, and KIFCO, and third-party banks, such that it is now difficult for anyone to ascertain the true nature of external exposures recorded in the names of certain major customers. It appears that over the period from 1977 to 1985, the treasury operations of Sandstorm made significant losses. These losses were concealed, and at the same time, significant profits were manufactured. The precise amount of such loans/fictitious profits cannot now be established, but may well have been in the order of $600 to $700 million before funding costs, or approaching $1 billion if funding costs are added. These losses were originally funded through unorthodox means at the behest of Abedi. The underlying situation at BCCI, already bad, worsened dramatically in 1985 as a result of a $500 million in losses incurred by BCCI in commodity trading undertaken through Capcom, BCCI's commodity trading affiliate, managed for BCCI by SM Akbar. According to Masahir Rahman, who was BCCI's chief financial officer at the time, this was equivalent to BCCI's entire capital and threatened to wipe out the bank. Pricewaterhouse concluded, in 1986 it was discovered that significant losses had been incurred in option trading. When Akbar resigned, he left a record of his activities with Redacted by Bank of England, who brought under his own control the amounts which had been financed by unorthodox means. Redacted by Bank of England set up a small central team under Redacted by Bank of England to review the record left by Redacted by Bank of England, to verify the representations made by Akbar and maintain contact with the customers. We understand that whilst Redacted by England attempted to establish some control by illegible customers' deposits, largely by using funds from Fork ICIC, he could not bring himself to make full disclosure, which would almost certainly have brought the bank down. Instead, as a result of continued pressure for profits and loan servicing, he continued to use unrecorded deposits, certain external funds with Fork Holdings, ICIC Holdings, and companies controlled but not legally owned by it, and funds were drawn down on bogus loan accounts in the name of prominent Middle Eastern investors. These funds were applied to adjust other balances in order to avoid making provision for bad loans and to conceal the past treasury losses in an enormous and complex web of fictitious transactions in what is probably one of the most complex deceptions in banking history. End quote. These losses now form a major part of the current deficit in the bank, which has been rectified by the financial support arrangements provided by the government in Abu Dhabi. Now we come to managers' ledgers and numbered accounts. Among BCCI's unusual practices was the use of managers' ledgers in addition to numbered accounts to manipulate accounts through back-to-back transactions that were essentially untraceable. BCCI insiders advised the subcommittee in early 1991 that these accounts were often designated solely as ML with a number following it, and often no one other than the BCCI officer responsible for the account would have any idea who, if anyone, owned it. In some cases, even the BCCI officer in charge of the account would be unable to identify its owner. Pricewaterhouse described this practice in BCCI Grand Caymans as early as in April 1986, stating that we have no particular objection to using numbered accounts, but we've found that in most instances, none of the officers of the Grand Cayman office were able to correctly identify either the name of the borrower or the credit officer responsible for monitoring the account at other locations. End quote. At the time, Pricewaterhouse suggested that BCCI should improve its management of such accounts to prevent such occurrences, but when the bank failed to do so, Pricewaterhouse took no additional action other than adding an asterisk to this notation in later audit reports, indicating that the recommendation had been made to BCCI more than once. Later, Pricewaterhouse noted how financial transactions from BCCI to its secretly held Swiss subsidiary loans were marked pay without mentioning our name, with the result that the recipients of the funds from loans were unable to determine from whom or where the money had gone. Pricewaterhouse's findings were later affirmed by its successor accountants Touche Ross, who handled the liquidation of BCCI. A year after becoming liquidator, Touche Ross noted that the true picture of BCCI's activities was distorted by such practices as loan parking, artificial fund transfers, the provision of multiple loans to a customer, each secured by the same property, and many similar improper practices. Now we get into BCCI concealment of treasury losses. In 1985, after rumours of BCCI's losses and options trading reached bank regulators, Luxembourg bank regulators asked BCCI to provide an audited review of its central treasury activities. BCCI selected Pricewaterhouse Cayman to perform the work, which determined in early 1986 that significant losses had been incurred and not recorded. According to Pricewaterhouse, it concluded that the losses and lack of record keeping were due to incompetence. However, in the 1991 Sandstorm report, Pricewaterhouse found that with the benefit of hindsight, it appears more sinister in that now it seems to have been a deliberate way to fictitiously inflate income. End quote. BCCI officials have confirmed that the account provided Pricewaterhouse in 1986 was designed to conceal the long-term nature of BCCI's inflation of its books. Zoyedin Akbar, sorry if I get that name wrong, the Treasury official held responsible for the massive losses in 1986 and fired by BCCI at the time following the discovery, told two BCCI officials in the US in 1988 that Akbar had been a scapegoat used by BCCI's management to deceive the auditors when the auditors had accidentally caught on to long-term manipulations by BCCI of its financial condition. Zuiddin Akbar told these officials that BCCI had been inflating its assets from the mid-1970s in order to make them look more profitable when it was not. When Pricewaterhouse discovered this activity in 1986, BCCI's top officials worked out a scheme with Akbar under which he would accept responsibility and pretend that the losses had just happened in the previous year due to unwise commodity speculations by BCCI. In that way, the losses would be viewed by outsiders as an unfortunate one-time occurrence, and with the sacrifices of Akbar, BCCI could continue. In its 1991 review, Pricewaterhouse found that among the specific techniques used by BCCI to hide its losses were misappropriation of deposits without depositors' knowledge to provide funds to adjust non-performing and bogus bank loans and treasury losses, misappropriation of external funds deposited under trust with Sandstorm, BCCI and Fork, ICIC, to be managed on behalf of a few prominent people who are also shareholders of BCCI holdings, the creation of loans with no commercial substance in the names of people without their knowledge, selling certificates of deposit placed with the Central Treasury without informing the depositors and using the proceeds to fund adjustments, routing funds through ICIC loans, KIFCO, SDCC and other affiliates and third parties to make adjustments prior to accounting reference dates and audit confirmation dates, which were often reversed at a later date. Now we get into ICIC, the bank within a bank. From the early days of BCCI, the various legal entities known collectively as ICIC functioned officially as a BCCI pension fund for BCCI officers and unofficially as BCCI's principal bank within a bank. The flexibility of ICIC to carry out many different schemes for Abedi is indicated by the number of different entities Abedi created using the identical ICIC abbreviation, including but not limited to International Credit and Investment Company Overseas Limited, International Credit and Investment Co. Limited, International Credit and Commerce Overseas Limited, ICIC Holdings of Grand Cayman, ICIC Apex Holdings, ICIC Overseas, Cayman ICIC Foundation, the ICIC Staff Benefit Fund, the ICIC Staff Benefit Trust, ICIC Business Promotions, ICIC Business and Promotions, and others. As BCCI liquidators in the Grand Caymans found, ICIC was not really a bank at all, but a post office box location to book transactions that were initiated, organised and approved in other parts of BCCI. In essence, ICIC was a conduit mechanism for BCCI's fraud. Some of the bewildering numbers of purposes and uses of the different ICICs included ICIC Apex Holding Limited, incorporated on October 2nd of 1987 as the ultimate holding company for the ICIC Group, equivalent to a charitable trust with the beneficiaries designed as mankind at large. ICIC Holdings Incorporated on April 6th of 1976 as the holding company for the ICIC Group, created as the holding company for ICIC Overseas. ICIC Holdings invested in ICIC Overseas and loaned money to ICIC Foundation and the ICIC Staff Benefit Fund. ICIC Overseas Limited, incorporated on the April 6th of 1976 as an offshore bank to facilitate the purchase and sale of BCCI shares and to provide private banking services for BCCI shareholders and customers. ICIC Overseas also advanced funds to nominees to allow them to purchase interests in 3 other BCCI affiliates, Atok Oil, Credit and Commerce Insurance, and the Saudi Development Company. ICIC Foundation Cayman, a charitable foundation wholly owned by the ICIC Foundation in the United Kingdom, established by a gift of BCCI shares owned by ICIC Holdings. The assets of the foundation were shares in BCCI, and the assets of the UK Foundation were 1/3 of the shares of loans, the secretly owned Swiss affiliate of BCCI. ICIC Staff Benefit Fund, a Cayman entity wholly owned by the ICIC Staff Benefit Trust for the benefit of BCCI employees, established by a gift of BCCI shares from ICIC Holdings. This entity held another 1/3 of the share of loans. Usually, correspondence and transactions involving any of these ICIC entities would refer merely to ICIC, leaving it to top BCCI management to determine which of the entities, if any, would get credit or be debited for the particular transaction. No one within BCCI other than Abedi, Nakvi, and a small circle of younger assistants had an overall picture of ICIC. To early Pakistani recruits to BCCI, such as Masahur Rahman, ICIC was described as a parallel organisation of BCCI which would hold shares of the bank for the founder group. In essence, a holding company controlling the stock of the BCCI holding companies. ICIC was also from the beginning a mechanism to disguise and misrepresent the ownership of BCCI. As needed, ICIC took on additional characteristics: bank, foundation and finance company. But its most unusual purpose was to act as a vehicle for BCCI's inflation of assets and concealment of losses, acting as a mechanism for at least $1 billion of circular transactions to inflate BCCI's books. The first detailed audit of ICIC conducted by Pricewaterhouse took place in 1991, with its draft conclusions provided to BCCI's board of directors on June 17th of 1991 in a report classified by Pricewaterhouse as strictly private and confidential. The Pricewaterhouse report provides cautions that its findings were based on records which were missing, falsified, or incomplete, but the picture drawn in the report again details fraud on a massive scale. The Pricewaterhouse audit found that BCCI effectively controlled ICIC and that most ICIC transactions were initiated at the instructions of senior BCCI management, Swali Naqvi, the number 2 man at BCCI, and 2 of his assistants, Mr. Hafiz and Mr. Imam. ICIC's uses included financing BCCI shares and capitalization through the use of nominees, buyback arrangements and guaranteed minimum return on investments, routing funds in a manner to disguise their true nature and effect on BCCI, providing guarantees through commitments signed by BCCI management on ICIC letterhead for various nominee arrangements for shareholders of companies secretly controlled by BCCI, such as First American through its holding company CCAH. Lending to BCCI shareholders and customers, paying BCCI expenses, handling the management of funds controlled by BCCI, Chairman Abedi through powers of attorney, BCCI buying its own shares through nominees through ICIC, processing financial transactions that were unrecorded at BCCI and which would therefore remain untraceable. In all, ICIC made $290 million in loans, all of which but perhaps $25 million is apparently lost. About $93.5 million of those loans were used to purchase shares of BCCI itself. Another $100 million in loans went to the nominees for BCCI or for routing transactions aimed at disguising BCCI's financial status. Another $20 million went to an ICIC subsidiary ICAC and effectively disappeared in ICAC's insolvency. Another $62 million in lending went to secure interests in other entities by BCCI shareholders, including people who were clearly serving as nominees. ICIC lending included millions to major frontmen for BCCI, including, and I'm going to butcher these names, Gahaith and Wabel Faron, Faisal Al-Falij, Prince Turki, and Mohammed Hammond. The role of BCCI of Hammond, who purchased the shares of Clark Clifford and Robert Altman in First American in 1988 with funds lent to him by BCCI, is illustrated by the fact that when his BCCI loans became delinquent, they were simply transferred from BCCI to ICIC. Examples of ICIC being used by BCCI to handle nominee relations include Wabel Paron writing ICIC on December 4th of 1984 to confirm that all transactions in BCCI shares in his names were undertaken as a nominee, Faisal Al-Falij writing ICIC on February 6th of 1985 to confirm that ICIC was entitled to all profits and was required to bear all losses on the CECAH, First American Bank shares in his name, which were being managed by ICIC. BCCI officer H.M. Kazmi writing Saudi Sheikh Kamal Adham on August 2nd of 1987 to confirm that Adham was not liable for any loans recorded in his name on the books of ICIC, including Adham's loans secured by his shares of CCAH for the First American Bank and Attock Oil. ICIC also offered unorthodox services, including guarantees against losses to prominent Middle Eastern political figures, including the rulers of several Gulf states. For example, BCCI-2 Swali Naqvi sent confirmation letters in February of 1990 from ICIC Holdings to the rulers of Ajman and Fajara, advising them that loans to them from BCCI would be paid off through proceeds from the disposal of their shares in CCAH, owner of the First American Bank. In the event that their shares did not cover losses, Naqvi confirmed that these rulers would not be required by ICIC or BCCI to pay them. It is notable that at the time Naqvi made this commitment, CCAH and the First American Banks had not been offered for sale to anyone. Now we get into money laundering. From the time of BCCI's indictment on drug money laundering charges in Tampa, Florida in October of 1988, there was little doubt to anyone looking at the facts that BCCI had been used to launder drug money. The customs agents working on the Sea Chase case against BCCI moved millions of dollars in US currency representing the proceeds of cocaine sales through BCCI Panama, BCCI Luxembourg, and loans Switzerland as a result of the knowing participation of several BCCI officials. As Robert Mauser, the customs agent in Tampa who selected BCCI as the target of the customs money laundering sting, testified, BCCI bank executives volunteered methods to enhance and improve his techniques for money laundering, and shortly before the sting ended the operation, offered to introduce Mauser to other potential cash customers for money laundering services from Bogota to Colombia. Attorneys for BCCI and the bank itself contended that the Tampa case represented an accident involving a small number of bank officers. Indeed, when BCCI itself pled guilty to money laundering in January of 1990, the bank continued to take the position that this guilty plea only constituted an admission that a few of its employees had engaged in the activity, and that its guilty plea was based solely on a theory of corporate responsibility. Respondit superior. As BCCI's attorneys argued to federal prosecutors and Senate staff prior to the bank's January 1990 plea agreement, it was inevitable that a bank operating in so many countries would be used by drug traffickers. This was partially true, as the Deputy Assistant Secretary of State for International Narcotics Matters acknowledged. Quote, setting aside those instances where BCCI managers knowingly promoted money laundering, BCCI seemed attracted to traffickers for the same reasons that other banks have been found attractive. First, traffickers seek international banks that are sophisticated in wire transfers, that have branches in those parts of the world where they operate and which permit quick retrieval of funds. Second, traffickers seek banks in those countries where national banking laws afford maximum secrecy to depositors, permit nominee accounts, and do not provide for close monitoring of cross-border transactions of currency movements. End quote. Given BCCI's size and dispersion, money laundering at BCCI would have been inevitable under any circumstances. Given BCCI's never-ending quest for assets and its management attitude towards laws, it was ubiquitous. As Akbar Bill Grammy explained, Abedi was constantly telling BCCI employees that the only thing that mattered was the generation of assets. When Bill Grammy was in Colombia in the mid-1980s, a period when Colombia had already developed the reputation as a center for cocaine smuggling and drug money, Abedi told him that he needed to increase BCCI's activity in Colombia to $1 billion in local currency and deposits and $1 billion in US denominated deposits, funds which obviously could only be generated directly or indirectly from the drug trade. BCCI's December 1991 plea agreement with US law enforcement outlines the systemic nature of the money laundering as follows. The BCCI defendants and their affiliates would and did formulate and implement a corporate strategy for increasing BCCI's deposits by encouraging placements of funds from the proceeds of drug sales in conscious disregard of the currency regulations, tax laws, and anti-drug laws of the United States and of other nations. In furtherance of the BCCI's group's corporate strategy to pursue deposits in disregard of United States and foreign law, the BCCI defendants would knowingly offer a full range of services to drug importers, suppliers, and money launderers. Co-conspirators would and did conduct financial transactions with narcotics, drug sales, including the wire transfer of said proceeds from places in the United States to and through other places outside the United States, with the intent to conceal and disguise the nature, location, source, and ownership of these drug proceeds. The criminal information entered into by the liquidators outlawed how BCCI laundered money, detailing its use of certificates of deposits held at foreign branches to offset cash deposits made in the US, its technique of crediting counterbalancing loan proceeds to foreign corporate bank accounts designated by drug traffickers, and BCCI's use of false names, codes, and counter-surveillance techniques against law enforcement, among other money laundering techniques. Knowledge of the bank's money laundering activity was not limited to a few high-level officials at the bank, as former BCCI Chief Financial Officer Masahir Rahman contended, as Abu Sakir, formerly BCCI's Chief Officer in the United States, testified. It's been obvious within BCCI as of 1983 that the bank adopted a conscious policy of soliciting drug funds when it decided to pursue a bank in Colombia. It was obvious to Sakir and other BCCI officers then that BCCI's motivation for obtaining the Colombia bank was its recognition that enormous amounts of US currency were being generated as a result of narcotics trafficking, and that Colombia could become an extremely profitable operation for BCCI. According to Sakia, we knew that the money we would be getting into Colombia would be drug money. We knew that all the dollar deposits we would be getting would be drug money. Sakia contended that his own attempts to discourage BCCI's entry into the Colombian market resulted in his being denied the position of becoming regional manager for BCCI throughout the Americas in retaliation for his unwillingness to go along with the BCCI's plan. Quote, if I'd agreed to the purchase of the Colombia Bank, I would have been the head of the Latin government region total, but I opposed the purchase of the Colombian Bank. I opposed it for 2 reasons. I didn't want that size of acquisition. We wouldn't know who the 500 people of staff we were taking over well enough. We were getting branches in lawless areas like Cartagena, Cali, and Medellin. There were armed guards every time I went from Bogota to the hotel in Colombia. I made an effort to get controls on our accounts in Miami because of concerns about drug money. I was opposed by London and by Amir and Salim Sadiq, who was also head of audit and compliance and simultaneously head of growth and profit. End quote. While Sakia provided key information to US investigators about wrongdoing at BCCI, other BCCI officers remaining at the institution scoffed at his provisions of innocence in the bank's criminality. Similarly, Masahur Rahman, who likewise provided vital information to this and other investigations, professed to have been excluded from all wrongdoing at the bank. But other BCCI insiders contended that Rahman assisted BCCI's inner circle in deception, if inadvertently through noting beneficiaries in BCCI's books and warning other officials of the risks if they were not corrected. As one BCCI official told investigators in the spring of 1992, quote, Masur Rahman was head of finance and he was a member of the Central Management Committee. He was never part of the inner clique of the top 4 or 5, and yet he had a very significant position because all of the balance sheets were reviewed by him. He packaged the balance sheets. He's a very intelligent man. If there were any shortcomings here or there, he came up with an idea of how to make it look good. As a professional, he dressed them up with when he saw deficiencies. He was a technocrat. He understood what the international world wants, whereas a lot of the others did not meet outsiders at all. From their point of view, that what was good enough for Pakistan or India was good enough. Masahur Rahman had a higher standard. He told them what they'd come up with, and Naqvi produced the proper figures in response. End quote. The degree of BCCI's US reliance on money laundering as a principal business was demonstrated by what happened when BCCI put into place a compliance program as part of its January 1990 plea agreement resolving the Tampa money laundering case. Business dropped noticeably, especially referrals from other BCCI locations, because either BCCI nor its customers wanted to provide details about the customers' businesses. BCCI's clients for money laundering included Panamanian General Manuel Noriega, for whom it managed some $23 million of criminal proceeds out of its London branches, Pablo Escobar of the Medellin cartel, Rodriguez Gacha of the Medellin cartel, and several members of the Ochoa family.